How do we prepare consolidated financial statement? And I know this is the moment you've been waiting for. But what I will tell you, first of all, is this is going to be very structured, because I want you to have confidence that anytime you see a question on consolidation, you can deal with it. So we're going to build the process gradually. But I will first give you initial 7 steps to build your confidence. Because the problem is, when people see consolidation state question, they don't even know where to start. Some of them will just start consolidating and start adding numbers together. You're going to get confused, no doubt, because sometimes you get overwhelmed and you don't even know the next thing to do and all of that. But I want to give you these steps, and what I will encourage you to do is every time you practice group account, please use this step such that you don't have to even think about this step by the time you are writing exams, because it will have become so part of you. The first step is, please draw the structure. It looks so simple, but it matters a lot. This is where your confidence will start from. Draw the structure. If the question says company A has acquired company C at 70% on 1st of January, draw the structure. Company A, acquire company C. Draw it like that. Give yourself that pictorial view. What you acquire 70% on this date is extremely important. 2000x4, whatever. See, this for information, extremely important. This first of all confirms to you that there's control. This date is extremely important. You must take note of this date in your workings because of other things you will do using this date, which I'm going to mention. Then the names of the company, very important, so that you don't mix it up as well. So draw the structure. The second step is calculate the consideration. And what is consideration? Consideration is just the cost of acquisition. How much did the parent pay to acquire C? How much did A pay? A could pay cash, it could pay by shares, it could pay by contingent liability, it could pay by any form, whatever he has used to pay. Add it together. Total together. Sometimes it is straightforward, sometimes it's not straightforward. By the time we start solving questions, we'll practice with these steps gradually and you'll see how it is. So, but you must be clear on consideration. How much did he pay? Whether it's cash, add all of them. Sometimes they will pay part in cash, part in shares, part in contingent asset. Add everything together. All the considerations must be added together. So, get that clear. Step 2. Step 3, you need to calculate your opening non-controlling interest. Non-controlling interest is usually called NCI. And I will quickly explain what NCI is all about. NCI is also what we used to call the minority interest. If that is the word you are used to, that's an old word. And what does this mean? This usually exists when the parent has less than 100% in the subsidiary. So e.g., from the example that we are using here, the parent acquires 70%. Then NCI will be the balance of 30%. So it's the balance of what the parent did not acquire. So on that date of acquisition that you have put in your structure above, you must know what is your NCI, because that will be your opening NCI. And it's very important, because when it gets to how you calculate the closing NCI, you need to know that opening NCI. So, and how do you get it? There are 2 ways that the question might ask you to measure NCI. Either they say you measure it at percentage proportion, of net assets, on acquisition date. Or they say you measure it at fair value on acquisition date. The question will tell you. So if it's the first one, you know that on the acquisition date, you'll be told the net asset of that subsidiary that is being acquired. Remember, when you are acquiring a subsidiary, what you are acquiring is the net asset. Is the net asset. Please take note. It's always the net asset. Yeah? And another name for net asset is equity. Remember your equation of when you say asset equals to liability plus equity. And what is equity? Equity is asset minus liability. This is your net asset. And this is your equity. So it's the same thing. So if they say percentage proportion of net asset, then you just calculate 30% of that. But if they say it's fair value, then they will give you the share price. Then you multiply that by 30% of number of shares that the subsidiary had on acquisition date. So either way, you will be told which you will use, and whatever you have been told to use is what you should use. Please don't say because you know both, you use one, or you say fair value is the market value, so it's a better value. No, please don't do that. Stick to what the question has asked you to do, and that will be your opening NCI. What is the fourth step? The fourth step is to confirm. You need to know. Confirm the net asset on acquisition date. I deliberately put this step here because I need you to understand step 2 and step 3 together, because you're going to be adding them together at a point. I know most likely by the time you'll be thinking, oh, we could have done this first before we do the opening NCI. If it works for you like that, it's okay, but just stick to this, it's fine. It doesn't stop you from knowing your net asset in step 3 and just still put it here in step 4. Right, so don't confuse yourself. Yes, confirm that net asset on acquisition date and put the figure here. So you have the figure of net asset. But remember, the net asset that you are talking about in step 4 is the 100% net asset. The total net asset of that subsidiary. Here, what you are looking at is NCI, non-controlling interest. Then step 5 is a popular goodwill calculation. So you need to get your goodwill, and you get it on acquisition date and also on reporting date. And I'm saying it this way because sometimes your goodwill on acquisition might not be the same as goodwill on reporting date. I hope you understand what I mean by these two dates. Let me quickly explain. Remember, we said acquisition took place 1st of January 20x4. That is acquisition date. However, this company might be preparing financial statement in December 31st of 12, 20x4. That will be a reporting date. So the goodwill on 0101 20x4 might not be the same. And why? Because of impairment. So if they tell you there is an impairment, you need to deduct that. And I will take a topic on impairment of goodwill in this section as well as we move on. But I'm building your understanding. So start slowly understanding the steps before we go into numbers. All right. So we'll deal with goodwill in section 5. You might be asking me, how do you calculate goodwill? I will show you. I can just tell you right away, it's super easy. Your goodwill calculation is just your cost, which is the same as consideration, plus your NCI opening, your opening NCI. minus total net asset. That's your goodwill. Yeah, that's your goodwill. And this is your total goodwill. So sometimes if the parent has acquired 100%, you see that this part will be 0 because there will not be NCI if it's 100% acquisition. However, most times they will not give you 100% acquisition because they want you to calculate NCI and all of that. Right. So you're going to have the cost, the parent cost, the NCI opening, then minus the net asset. That will give you your total goodwill. Yeah, and this goodwill can actually be, if you want to separate it, to give you the same answer. If you want, you can also do it in two parts to say we want to calculate the parent goodwill first and calculate the NCI goodwill. I'm taking time to break it down like this because I know some of you probably have done the paper before, struggle with some concepts. So if I break it down like this and show you different ways, you can relate with maybe a method you have been using before that's not been working. Yeah. So sometimes you might need to break it down to NCI goodwill or parent goodwill, which is nothing difficult. What it just means that if you want to get parent goodwill to be cost minus percentage acquired of net asset. Yeah, and NCI goodwill will be your opening NCI minus percentage NCI of goodwill of net asset. If you add this together, both of them will still give you the figure you have above. It's the same thing. Okay? And I hope it's making sense. So once you have your goodwill, you go to step 6. That is just build your template. And what is template here? They would have given you a set of financial statement. Just put empty shell. Non-current asset, depending on the items they've given you. Current assets, then please put goodwill. Always put goodwill. Even if it is 0, put it in your template so that you have it. So list investment. If there are investment, they've given you all the items they're giving you on the financial statement of financial position. On asset side, list it. On liability side, list it as well. Maybe they give you loans. They give you maybe current liability. They give you deferred income. Just examples. Then you have share capital. Yeah, share capital. Maybe there's also share premium. There will always be retained earnings. Right. So here you have total asset. Here you have total assets, total equity. Yeah. For parents, this is for parents. Then you now have your NCI. Then you have total equity, liability, and NCI. This will be equals to this. And that's when you are balanced. So, this template is just, I will demonstrate all of this to you when we go into solving questions. So, it's just you listing out the items. Yeah, that you can see on the statement of financial position. List it, don't put any figure, just list them down like that. Yeah, list them down. Then you can now move to step 7, which is when you consolidate. And you can see that it's actually a lot of work to be done before you start consolidating. Now imagine that someone just jumped into this step 6. You want to start consolidating. You're going to struggle. So take it slowly, build your understanding, start from the structure. You know the structure, you know the date of acquisition, you know the percentage. Yeah, get the consideration that was paid, know your opening NCI if there is any. Then if you're done with that, get the total net asset of the subsidiary that was acquired, calculate the goodwill, then go into your template and consolidation. It's as simple as that. Now I know that your next question will be, okay, how do I consolidate? Now, fewer steps. fewer steps. This recording is extremely important for you because this is setting the foundation before we start building even more complicated things and questions. Right, very critical. To consolidate, I'll just give you 5 steps that you need to start using to practice now. Yeah, and we'll be using it in questions as well. So I'll give you 5 steps that you must do. And let me also tell you, the good news is don't get rattled in exams when you do consolidation or even when you practice. If it doesn't balance, it doesn't stop you from scoring 90% of your marks, even 95% of your marks, because each step will be marked. Okay? So, step 1 that you must do is you must remove investments in subsidiary amount. You will always see that instead of the financial position of the parent financial statement. So you must remove this balance. Investment in subsidiary. Remove it from the parent. From parent FS. And you see, let me remind you that your understanding of debit and credit is extremely important and still important in consolidation. In this financial reporting, and that's why you must understand financial accounting before doing this paper. But if you struggle with FA, you are lucky because I will be breaking it down as much as possible for you here so you will understand it. So don't worry, just stay with me. Right? Remember, removing subsidiary investment in the parent financial statement. In the parent financial statement, this will have been an investment, which means an asset. And asset is usually a debit. So if you want to remove an asset, you'll be posting a credit. So removing means that you're going to be crediting investment in subsidiary. Yeah? In the parent financial statement. The debit must be posted as well. And the question is, where would the debit go? So when you are preparing consolidated financial statement, what you have is an opportunity to credit and debit any of the financial statement, whether subsidiary, whether parent. The debit and credit would not have to stay within parent or within subsidiary. You can be debiting parent and be crediting subsidiary. It is allowed. That is why the essence, the objective of preparing the consolidated financial statement is to make the user see the financial statement of groups of companies as if they were one, right? So, and that is why you can post within and across. So the debit will go to the pre-acquisition equity of the subsidiary. So what we are saying is that the same way you are removing the subsidiary amount in the parent, you're going to be removing the share capital and retained earnings of the subsidiary. That's the first thing you must do. This first thing and the easiest mark to score once you start. Take both out. And don't worry, I know the next thing in your mind is, what if these amounts are different? Because this will have been at cost. And this definitely might also be different amount. Right? I know it can be different amount because you could have paid more than the worth of the subsidiary. That is the concept of goodwill that I explained here. That will be the balancing figure most times. Your balance, depending on whether there's a difference, there is going to be a possibility of debit or credit to balance that as goodwill. And that is why when I get to goodwill as a topic, I'll be teaching you when it can be a debit and when it can be a credit. Because if goodwill is negative, then we will see it's called bargain purchase, which is an income. So becomes credit to PIL. Yeah, but we'll go into that. Let's not complicate it. Gradual process, So that's your first entry. Removing the investment in subsidiary amount from the parent and removing the share capital and the return earnings of the subsidiary. So the equity of the subsidiary is gone. Then you can now go to step 2. You're already becoming an expert in consolidation. You need to make adjustments. And the popular adjustment is what we call the elimination of all intercompany transactions. I'm going to take intercompany transaction as a different video. Elimination of all intercompany transactions. You must take it out. And why do you think this is important? Remember, if company A has acquired C, 70%, which means it has power over C. So it means it's going to control C. And it's going to control C to make benefit. Right? Then there's a likelihood that it can tell C to buy a product at any price. It can tell C to sell a product at any price. And this time around, buying and selling to himself. So, which means there's a likelihood that A might be having some unrealistic profit in a single financial statement because it has a subsidiary. It can't be transferring his losses to subsidiary. It can't be transferring his nightmare, his problems, issues to his subsidiaries because maybe the subsidiary is not even listed, so not even required to publish account. And A might be listed and wants to make the users of account to see that he's doing very well. So by the time users can see that A has subsidiary, then the next thing is they want to see the account as if both of them are single entity. Because that is when they will know exactly what is going on in reality. And because of that, any interactions, any transaction that is between two of them must be eliminated. And that is the reason why elimination is important. You can be asked in exams, why do you have to eliminate intercompany transactions? It's because A might be doing illegitimate transactions with C just to deceive the users of accounts, to make his own separate account look good, even when they are fictitious. They can't be fictitious. Very, very common. That is one of the things that ran down Enron. If you remember the Enron case, they had SPs that they were transferring their losses into. And that time, SPE was not consolidated. And that's one of the reasons why a new standard came on consolidation of all SPEs, special purpose entities. Okay, now make all those adjustments and you can now go to step 3, which is to combine. This is the easiest one that everybody likes to do. Combine all assets and liability. All, when I say all, no proportion, 100%, please take note. 100%, you must add all of them together. All the asset and liability left. Remember, you would have removed this investment in subsidiary. And once you have done that, merge all the asset and liability, and you must have removed all intercompany transactions, whether on balance sheet or P&L. But remember, for this one, we are focusing on sort of financial position. That is what we are learning how to consolidate for now, right? Let me tell you that clearly. Remember, here we are looking at statement of financial position. When we finish with statement of financial position, we'll go to income statement. So all the steps I've been giving you is just for statement of financial position. Please take note. Right. So we'll combine all assets and liabilities. And once we have combined, then we can go to step 4, which is calculation of group retained earnings. And how do you calculate group retained earnings? This is very important because it can be a standalone question on itself. Yeah. You start with the parents' retained earnings, then add, and is plus the parents' portion, yeah, percentage, times post acquisition profit or acquisition retained earnings of the subsidiary. So what am I saying here? Take for instance, on 1st of January when we acquired, retained earnings, I say retained earnings of the subsidiary is 500. By 31st of December, it is 800. We don't have business with this 500. Post-acquisition retained earnings is 800 minus 500. What we have business with is 300 in our consolidation. So which means if it's 100% acquisition, the whole of 300 will be added. However, if it's 70%, as we have been doing, then that will be parents' retained earnings plus 70% of 300. That will be retained earnings for the group. Please take note. It's always the parent retained earnings plus post-acquisition retained earnings in that proportion. Very important. Then the 5th stage is to calculate your closing NCI. If you have, which most time, like I said, you will have, because they would not give you an easy question that will be 100% acquisition. I don't see that happening. So prepare your mind to learn how to calculate the closing NCI, which is just your opening NCI, which you already have earlier on the date of acquisition. Here, this step 3 here. So you have the opening NCI, then all you need to add is the percentage of returns of the subsidiary. Please take note. Pretty easy. You don't need to struggle at all with this one. Remember, once you know your opening NCI above, the closing NCI is just easy. Because all you need to do is to ask yourself, what is the post-acquisition retained earnings? Yeah. Just like you did here. This will have been 30% in that example, plus the opening NCI, which you already have. And with that, that will give you your closing NCI. And if there's any other reserves, maybe other reserves or evaluation reserve or whatever it is, you follow the same percentage of retained earnings on post-acquisition. It's always similar method for all the reserve accounts. The same way you do retained earnings, you do for the other ones. But like I said, gradual process, we keep building this understanding. Yeah. And those are the steps I need you to learn. So please take your time, go through again. Remember your initial 7 steps and your final 5 steps. Those are the things you need to know first. Try and understand each of these steps. At least, even if you have to memorize them. Put them on your card or maybe a sticky note or something. Look at it. Anytime you want to prepare a consolidated financial statement, use those steps. And with that, I believe you will be home and